Bloomberg Audio Studios.
Podcasts, radio, news.
Yeah, well, one of those days where, a whole third of the market cap of the S&P 500 reports. Second quarter Google Cloud revenue coming in above estimates, $10.35 billion, beating estimates of $10.09 billion. Second quarter revenue, excluding the traffic acquisition costs, coming in above estimates at $71.3 billion versus estimates of $70.7 billion. So, in sum, second quarter revenue, excluding TAC, meeting estimates.
Yeah, so we did see some pressure on shares of Alphabet here in the aftermarket. So let's get to it with our team. In the house is Bloomberg Intelligence senior tech industry analyst Mandeep Singh, along with Bloomberg News earnings reporter Red Brown, both in our Bloomberg Interactive Broker studio. All right, Mandeep, walk us through it. The surprises, the strength, the weakness, or anything that raises questions for you.
I think search once again performed very well. It was better than consensus. And with Alphabet, whenever search beats consensus, the operating margin beat will come. And that was the same here. The only number that disappointed was the YouTube ads revenue.
Yeah, that was surprising.
And I watch a lot of YouTube. I don't know what's going on.
Yes, because you could pay to get rid of the ads.
Yeah, we watch them sometimes.
So up until last quarter, they made it up through better YouTube subscription sales. Now, that doesn't seem to be the case because the YouTube subscription number is reported alongside the App Store revenue. So it's hard to unpack whether that was the weak part or the App Store revenue was the weak link. But clearly, YouTube was a disappointing segment in the results.
Investors don't seem that disappointed. I mean, shares of Google right now, they're bouncing between red and green. But, I mean, we're talking small moves. And look, these are after hours.
It was down a lot more.
It was down a lot more.
Ago.
Yeah, and this is before the call, Mandeep. But is this like a kind of ho-hum earnings report?
I think, look, when I look at search growing mid-teens, that just tells me, a company with $200 billion run rate in search business, 90% market share, still manages to grow double digits.
So it's experimental AI is working?
It's working, and it's maintaining market share despite competition from ChatGPT, Bing, you name it. Everyone keeps talking about how they
He just said Bing.
He said Bing.
Is there really competition from Bing?
Well, Bing has integrated ChatGPT now. So that was what Satya Nadella was most excited about.
I am curious about the lack of ads that I see when I do a Google search and I see the experimental AI result. It doesn't seem like they're making money from me.
Yeah, but if you go back in time, Google only monetized 70% of their queries are not monetized. Only 30% are monetized. And that too, it's a very keyword-driven business. So, people bid up for keywords. That's what drives the ad pricing. And in this case, unlike social media that can increase ad loads, Google is not increasing ad loads. It's still keyword-driven. And they're able to maintain that share, despite ChatGPT coming in. And for certain queries, I'm sure people are going more to ChatGPT than coming to traditional search. But I think Google has a competing offering with Gemini Advanced, and that will be a subscription revenue stream down the line. So in short, they've been able to maintain their market share despite all the threat. And I think that's good news for us.
Stock is down about 1% here in the aftermarket, but it's been bouncing around. Stock's up about 30% year to date. Forward PE of 24. Alphabet has gained more than 16% since its blowout first quarter report. And Red Brown, I want to bring you into it, watching it as well. Join the conversation here with Mandeep. I'm wondering too if this is a quarter that, safely, easily lives up to expectations.
Yeah, I think Mandeep really hit on obviously the two biggest things that jumped off the page to me as well, which was search and YouTube coming in a little softer. But the other thing that's really jumping out to me is actually CapEx. If we think about how are they competing with these other companies on Gen AI, that's where we'll see that investment. And from what I can see, CapEx coming $13 billion. That's I think the biggest ever for Alphabet. I think that kind of really speaks to where they are headed and kind of another doubling down on this commitment. And it seems to be paying off. Between the search business continuing to grow despite its size, definitely interesting there.
And I just want to, since you brought up CapEx, CapEx is directly related to their cloud revenue.
Yeah.
So the fact that cloud sales grew 29%, that CapEx is paying off. And
money well spent, basically.
Money well spent, and actually cloud margins grew 650 basis points. So for the longest time, Alphabet was criticized because cloud wasn't making money. it was a drag on profitability. Well, guess what? In just the past 2-3 quarters, they have shown over 500 basis point of margin expansion in the business. And that seems to be the trend. I think based on the guide, they're saying this will continue.
Well, this is what we always talk about, right? Because they behind what Microsoft and Amazon, right, have lagged in terms of the cloud. This shows what, that they're making progress.
Well, they had a slower start. So they were always the third player, the distant third player.
Yeah.
But look at the cloud revenue run rate now. $40 billion. Compare that to Microsoft Azure, $76 billion, and Amazon AWS, $100 billion. But at least they're growing 30%.
Yeah.
So we'll find out whether Microsoft Azure is also growing 30%, but we know Amazon AWS is growing 17%. So clearly their faster growth will help them narrow that gap.
Mandeep, speaking of AWS and Microsoft, what do these results tell you about what we should expect for those companies when they report later this quarter?
I think for Microsoft Azure, again, it's going to be a very strong quarter. You will see more than 30% growth. And Microsoft actually quantifies the contribution from generative AI workloads. Last quarter, it was 7 percentage points. Mm-hmm. I'm expecting it'll be slightly higher this quarter. But clearly, that's where IT spend is going, is in the generative AI workloads. And I think Microsoft will do better than AWS because AWS has been coming from behind when it comes to generative AI.
I just want to mention Amazon. I'm just looking in the aftermarket, very little movement, maybe up about 1/3 of 1%. And I just want to look at Microsoft. They're down about 2/10. So I don't know that they were necessarily seeing any kind of significant reaction.
Okay, it's not just Alphabet, but one company that is seeing a more significant reaction after hours right now is Tesla, down 4.6%. As we speak. Second quarter adjusted earnings per share missed estimates, or EPS, adjusted earnings per share for the second quarter missed the average analyst estimate. They're also getting quite a bit of information on from the long presentation about how many cars they plan to deliver, fewer than the 1.8 million cars they delivered in 2023. I know you guys are here to talk about Alphabet, but we can't let you leave without talking a little bit about what we saw with Tesla. Mandeep, what sticks out to you?
I mean, look, with Tesla, the fact that they shifted out the robotaxi event, that's where all the excitement was.
Yeah.
And, right now, they don't have a near-term catalyst. Everyone is excited about AI. That is where they could have shown their AI. I mean, I know humanoid robots are also a big deal, but they gave a date and then they backed off. So to me, that was never a good sign going into the print.
What about for you, Red?
Well, I think it's interesting that the thing to get excited about is kind of this pie in the sky idea of a robotaxi that no one has really been able to successfully monetize yet. I think that kind of speaks to where the company is at, maybe getting a little bit away from its true mission, which has always been selling EVs. But I think there are some positives to take away from this report. They did improve. They did actually beat gross margin expectations. I think that's going to be really important for investors going forward. Is how can this company continue to trim expenses if they aren't going to be seeing really aggressive top line growth as they were in the past? So good to see them focusing there on improving the efficiency a little bit.
All right. So just to wrap up, top question for Tesla that you would make on the call, real quickly.
It's got to be the roadmap to continuing. Where is the robotaxi? Where is the robotaxi? When is it coming? And again, is there anywhere we can continue to trim costs?
Red, just show me the robotaxi, Elon. That's
I want to know about the mass market car that's going to sell tons and tons.
It's the Model
and tons.
3.
Yeah, I guess. Okay. I don't know. Go ahead.
Investors care about FSD software attach rate. That's where the margins lie.
Explain attach rate real quick.
So attach rate is any Tesla EV owner that buys the software. So, attaches, if I end up buying $12,000 of FSD software for autonomous driving, that's like 90% plus gross margin. Yeah. That's what investors get excited about Tesla because they think that ramp will continue to grow. The attach rate will continue to grow.
Software company, not a car company.
10 seconds, top question for Alphabet on the call.
Alphabet, it's really about cloud growth. I mean, how fast can it grow and how long, the durability of that cloud growth, the 30% cloud growth.
Unbelievable. Mandeep Singh of Bloomberg Intelligence and Bloomberg News earnings reporter Red Brown. Guys, thank you so much. So appreciate it. This is Bloomberg Businessweek.